Hey guys, welcome back to the channel. I'm Luke. Today we're going to be discussing the tax benefit on debt. So when a company raises debt, it benefits from a concept known as the tax shield. So the interest expense that goes through the P&L is a tax deductible expense for companies. It reduces their corporation tax, their corporate income taxes that they pay. So we'll discuss all of that. Let's get into it. Okay, so debt. So one of the key benefits of raising debt financing over equity, from the perspective of the company, mind, is the interest cost on debt is a tax deductible expense. So incurring interest expense will reduce the firm's tax bill, which is a good thing. You will pay less tax to the government. The more debt you raise, basically. The more debt you have, the higher your interest payments, and the higher your interest payments, the greater tax benefit you'll get, which will reduce the amount of cash payments you're making to the government every year. So a lot of companies like to maximize or increase their leverage levels to benefit from this tax deductibility. So let's do a quick example to explain how this works. So let's assume we have a company that has revenue of $20 in a year. It's quite a simple company. It has operating expenses equal to $6 and interest on its debt of $4. So what's the taxable profit if we assume that interest on debt is tax deductible? So the taxable profit, i.e. the profit that is subject to tax, is equal to the revenue of $20 less the operating expenses of $6 less the interest expense of $4. So that's $10. So that $10 of profit is subject to tax. So let's assume in this example we have a tax rate of 20%. Therefore, the tax due to the government is 20% of $10, which equals $2. So the company's post-tax profit or net income is $10 less $2 equals $8. So the profit after tax that the company earns, assuming that interest on debt is tax deductible, is $8, and the tax due to the government is $2. And this is, just to be clear, this is the scenario 1. Interest on debt is tax deductible. So let's do scenario 2 now, just to compare. So if we assume interest on debt is not a tax deductible expense, what impact will that have on our P&L and on our cash flow? So exactly the same revenue, exactly the same operating expenses and interest expense of $4. However, because interest is not a tax deductible expense, this time out our taxable profit is only equal to $20 minus $6 equals 14. So you can't deduct the $4 worth of interest expense. Tax rate is 20%, therefore in this scenario the tax due equals 20% times $14 equals $2.80. So we're paying more tax. The post-tax profit in the income statement is $10 because we're still paying the interest expense, it's just not tax deductible, minus $2.80 equals $7.20. So if the interest on debt wasn't tax deductible, we'd be paying more tax, we'd be paying 80 cents more, and we'd earn 80 cents less profit. And remember, profit is what is due to the shareholders once all other expenses have been paid. So there's going to be less profit available to distribute to shareholders as a dividend. And the company is going to pay more tax to the government. So that, hopefully mathematically, as a very simple example, shows you how this concept works. The interest expense on debt, being a tax deductible expense, generates more profit for the company as they're paying less tax. Improves cash flow, and more profit is available to the shareholders. So we're reducing the company's tax bill. One thing very important to note, and one final point on this topic, is that dividends are not a tax deductible expense. So interest expense is, so the more interest expense a company pays, the greater the tax benefit, but dividends are not tax deductible. So you can pay a higher amount of dividends, it won't change your tax bill at all. So we won't be reducing the firm's tax bill. So there's less of an incentive for the company to pay them. If you think about things from the perspective of the company, they want to maximize cash flow, they want to reduce the amount of tax they're paying to the government. Obviously, they want to remain and do things legally, but within the realms of what's legal, they want to reduce the amount of tax they're paying to the government. So there's more of an incentive for them to issue debt, because the more debt they issue, the less or lower the firm's tax bill, whereas there's less of an incentive to pay dividends because there's no tax benefit to the company of paying dividends. So yeah, hopefully that was helpful. Hopefully you guys are a bit clearer now on how companies benefit from a tax perspective from using debt as a form of financing. There's less of an incentive to use equity because your dividends aren't tax deductible, whereas interest on debt is. Any questions, feel free to fire them off in the comments, and I'll see you guys in the next video.